Good Friday morning, everyone, and welcome to Rethinking Balance Sheet, the show where we dissect the balance sheets and we help SMEs to look at the balance sheet in a very different way. And joining me, as always, every Friday is my co-host, Ravi from Stage 3 Capital. Ravi, welcome to the show. And Ravi, it's another exciting episode today. It's been 20 weeks, right? We've been running this on the go. And, we've been talking about so many different things over the last couple of weeks. Ravi, you want to just share a couple of quick insights you've learned over the last 20 weeks?
Oh, gosh. I think at every show you learn something. But if anything, I've also learned a little bit about hosting shows. That's probably the most I've learned about probably hosting shows. I think we've had, we're having Wong Yok Ming come in and talk about lead market, and it's how reasonable it is to list in Malaysia. We've had the guys from P2P Money Safe come in. We've had the P2P solutions also Puva come in. Finance to You again. All this has just showed us that again there's a lot of new stuff out there. Yeah, on that vein of new stuff, perhaps not so new but very topical. This week, which is the special purpose asset companies, SPACs, as they're known as. We are going to talk a little bit of that. And as you know, Grab, Asia, the promoters have absolutely been discussing that. So it's been a way of raising finance. I mean, yes, we do want to help as much as possible as SMEs, but as you know, Roshan, this show is a little bit more than just only SMEs. It's also about bringing the whole world of corporate finance and the balance sheet to the wider audience, and we're definitely getting good traction on that. So here we're going to have some of the more technical topics as well, and we've got someone very, very good to speak about this week, Ms. Lee Ling from the CEO and Group CEO of Hong Leong Investment Bank. She's obviously a very experienced person. She works for Tan Sri Kwek Leng Chang, so he's up a snowful, so she's damn smart, I can tell you that. And of course, she's got a tremendous career going back to Schroders and the works alike. So again, we are very fortunate. And on that note, she's also obviously had all the SPACs which have been successful, especially Hibiscus per Heart, which has really gone on to do wonderful things in Malaysia. It just shows you're given the right amount of capital, you get somebody like Dr. Ken Pereira in charge of a business where you can go from just virtually nothing. I think the market cap's exceeding R1 billion again. So it is a way to grow. Definitely a story. But I think in today's show, we've also got the benefit of Ms. Lee Ling. She can talk a little bit more broadly about investment banking and the balance sheet as well.
So let's bring Ms. Lee Ling into the show. Ling, welcome to the show, and really, really happy to have you with us today.
Hello, hi everybody.
And
hi, Jim Ling.
Hi.
Jim Ling's the CEO at Hong Leong Investment Bank. Maybe just to kick us off, just share a little bit about who you are and how you got to where you got to.
Okay. There's nothing much of a life history that I have. I mean, not as fantastic as some of these people would think. But I think most of you here would know me. But for those who really haven't met me, haven't come across me in anywhere in the financial industry, I spent most of my entire career life in banking. I think at the end of the day, where I started off as a commercial banker. I think most of you would know. I actually started with a commercial bank and doing corporate banking work, and then after that I joined Schroders in '93. And since then, I've been in investment banking and never looked back since then. But I think what is amazing is that in that 30 years, I think in what we do, I think what is interesting is that, investment banking is constantly, there's an evolution everywhere. I mean, if you look at SPACs, I think Malaysia has actually, as a capital markets, have done well in terms of looking at the various products, right? You look at how we have evolved over the years. I think when in Schroders, we actually did the first serial bond. Those days we never even had the benchmark yield curve in Malaysia. So we actually arranged the first 1 billion serial bond for Plus those days, and that actually created the benchmark yields, right, for the yield curve. So that is something that we are actually quite proud of when we did it at Schroders. And then, of course, from Schroders, I think most of you would know, I moved on, spent a bit of time in Affin Hwang, before finally joining Hong Leong in 2009. And it has been more than 10 years now. Actually, crossed my 10-year mark in 2019 and into my 13 years now.
Wow,
I
amazing,
must
amazing.
say, it's amazing that in '93 you were in Schroders. Does Schroders take on teenagers?
It's a child genius. Ravi, child genius is fine, Doogie Howser,
I'll buy you a coffee when MCO is over.
And in the show, there's a whole bunch of people who just joined us. We have Selena, I think, who says, "Hey Jim Ling, I don't know. I think you might know her. Watching cause of you." And then Dalvin Kaur says, "Hi Jim Ling, nice to see you again. Looking great." And then they're talking.
I agree that.
There's a couple others. I think Delvin and also Molly are good friends. I think.
Okay.
So we all miss you. So I think there's a big fan club up there. There's another good morning from someone else. So a lot of people joining in. Thank you for joining in. And if you anytime have any questions for Jim Ling or for Ravi or for myself, just kind of shoot them in the comment section, and we'll be happy to get that back to you and try to answer as many as we can during the time we have. So, Jim, you are part of the investment bank at Hong Leong. And if you think about the investment bank, kind of its function and what it does, right? How do investment banks really improve the balance sheets of corporations? I mean, what do you guys do?
I think the key thing, most people has this connotation. I mean, what does an investment bank do? I think the first thing that comes to mind is that we talk about investment banks, we talk about the need to raise capital, right? So the key thing about investment banks is that, of course, banks are also fairly good. I mean, the commercial banks are already also a very good fit in that realm. But then I think most of the commercial banks, of course, they look at the traditional markets. I mean, they lend the money themselves, they give the balance sheet. Investment banks raised it through the public capital markets itself, where we actually deal with investors, so from our perspective, I think the key thing about clients today is that when we look at our clients, we shouldn't look at it from a product approach. We look at a client from a value proposition approach and ask ourselves, what really does the client need, right? I mean, of course, we look at different times where different products are more suitable. There's no one product that fits every client. So over the years, you look at it, even on today's topic, where the SPACs come about. I mean, there must be a reason. It's not just that SPACs were born because it was just a product itself, but it's the evolution of the market leading to the demand of certain products. So if we look at what the investment bank traditionally do, actually, you look at the birth of the company, that's where we start with, right? When you start a company, you go to a bank, borrow your first 5 million, buy a factory, buy your equipment. And then as you progressively grow, then of course the bank fits into your so-called asset conversion cycle, right? You actually borrow for your working capital needs. Then the next phase, you think about it and say, okay, I need to further grow my company. Then where do you go? Now, then after a while, the bank may say, okay, every time you want to grow, you have to put in more equity. And to some people, capital become a constraint in business, right? I mean, whether we are, even a bank itself, we have capital constraints, right? I mean, we have to maintain certain capital to drive our business. So when you look for more capital, what do? Then you go to the what we call, so the very popular space today, also aside from SPACs, we talk about private equity, right? So you can actually look at private equity. Then if you're not ready for a listing, because some people tend to feel that, we are not ready yet because the private equity come in as a bridge gap where, you actually have a little bit more space to actually grow your income to a more sizable level for you to reach the public offering. So then that's where, investment banks can come in so many ways, find you private equity investors, find you more money from the bond investors, which is what we call the fixed income investors. Then eventually, of course, we can also find you money from the public markets through the initial public offering itself. And then, of course, in what form the IPOs, that's why today we are talking about whether you do a traditional IPO, whether you come through the SPACs, which is basically a very hot topic now because everyone seems to be talking about SPACs. And again, there are a reason why people look at SPACs rather than traditional IPOs. Yeah.
Wow. Yeah, and we will come to SPAC in a bit. I mean, but more people joining us. We've got Dr. Ram says good morning, and we've got Aini who says you're looking great, Jim.
Morning, everybody.
Back to before we get into the topic of SPACs, maybe we should, when you look at your own organization, Hong Leong Investment Bank, and the value proposition that you have proposed, right? How is that differentiated from other companies and other investment banks?
I think in terms of value proposition, I think most investment banks actually today have more or less, I think, the same structure, in the sense that I think we have evolved. I think those days, I recall when I first started banking, I don't know about the rest of the banks, but most of us are actually very much product heads, like you run corporate banking, and then you can run trade finance, you can run treasury. But today, I think most investment banks are champion against what we call the client coverage models. I think what we should do is make sure the client get the best solution, rather than 10 people from the same bank seeing the same client, right? I mean, after a while, we also realize that even insurers, we find that we have so many people from different parts of the world going in to see the client. The client say, why am I meeting your people every week? Either your DCM team from UK is coming to see me, your project finance team from Tokyo is coming to see me. So there's so many parts of the same bank coming to see the client. But today, I think the championship model has actually more or less evolved, that you actually have a group of business managers looking at the client and then looking at what the client needs. So in Hong Leong IB, we are not different. We are organized against a group of what we call the client coverage teams. They actually cover the clients from A to Z, meaning they look at all the needs within the client's requirements, and we basically build solutions around what the clients require. Now, why? Wouldn't say something that's very different, but I think what we like to say is that in Hong Leong, I think we like to look at what really drives the client's value proposition. So you look at what we have done as a first, like SPAC. I mean, when Ken first came to see me, he said, "Hey, Jim Ling, we want to look at SPAC. Would you do one for me? Even though I may not have the fees to pay you." Because if it's not successful, actually, it really is very, very, very true. We had that conversation, and Ken said, "Hey, what happens?" I said, we look at it as a partnership, right? As a sponsorship. I said, we in Hong Leong want to do innovation, right? We really believe that we should. I mean, when products are right, we should bring it to the market. And here we have our dear Ken, who is so good in the oil and gas sector. He is a master in that field himself, but having looked at it, he has all his ambitions, and he really wants to drive that particular proposition. But then, of course, to be fair to him, everything is subject to market. I mean, when we look at the first SPAC, what was the key risk? Market acceptance, right? Because it's the first. When you have the first to market, you always have that issue, whether people would accept that product, whether people would buy it. And so he says, what if I don't have? I said, okay, let's invest in this now. So we went in on the perspective that, okay, if it doesn't work out, okay, fine, we may have to write off a lot of work done, a lot of months of hard work, and potentially no returns. But I think when we look at innovating, we need to think of something like that. I mean, we don't really think of it as a first part where, look at the returns first before we start. So this has been the kind of practice that we have been embracing, in the sense that we actually really seriously wanted to do something different, and that's how we brought hibiscus to the market. And of course, today we are happy to report that hibiscus actually has really migrated themselves, from a SPAC baby to a full-fledged large cap listed company in Malaysia. And that really, we congratulate Ken and the team for all the hard work they put in, and it has been one of the most successful journey for them. Yeah.
Sounds like a plan. I should be having a dialogue with you on bringing Necole to market with no fees, right? Ravi, sounds really good.
Yeah, that sounds good.
I think what we hope is that what we're saying now.
No.
But
I understand. I mean, there has to be a win-win. There has to be a value partnership on both sides to the equation, right? But I mean, that provides an opportunity for unique, first-time offerings to have that dialogue, I think, with people like you. So I mean, that's very, very interesting. And let's talk about SPAC. And Ravi, you want to jump in on this whole SPAC piece?
Yeah, I think not all of our viewers will know what a SPAC is and what's the driver. And I think perhaps where you talked about Ken and the market acceptance is probably what's the driver, what's driving AirAsia, what's driving Grab to go down this model rather than an IPO per se, or any other way of raising funds at this stage?
Yeah, I think if you look at the evolution of how SPAC came about, right? I think maybe we can actually contrast it between a company, as what I have mentioned earlier, going for an IPO, right? I think the basic difference is that IPO is where we started off with an operating company, with a profit track record, who feels that they have actually matured enough and need to raise. I mean, at the end of the day, if people look at listing, right, there must be some element of wanting to raise further capital for growth, right? So from that perspective, IPOs, very typical IPO starts with an operating company. But then people then say, okay, what if I have a very good business but growing very fast and I didn't necessarily meet that track record, right? So that's when, now you look at people like Grab, people like AirAsia, who is really contemplating the listing of its digital, the tech part of the apps. Then do we not have a market for any of our capital raising potential? So then the question next comes is that then SPAC basically is what we discussed this morning, just had a quick chat with Ravi before we started our session here. We call that, in a very nutshell, people say blank check companies. But the key is really, what is SPAC? SPAC is when we list a special purpose acquisition company. This company does not have a business. It just raises money and becomes a cash cow that will look for the business. Of course, the slight difference so far between the Malaysian models and the US models is that US models tends to have the sponsors as being the fund managers themselves. That means if today Lee Ling decide to quit Hong Leong, I can actually go and start a SPAC. I can actually, if people believe in my expertise in finding a good investment, they can actually buy my SPAC. But then necessarily when I buy into a company like Grab, I don't need to run that company. Whereas in Malaysia, if you look at the history, Ken actually is the promoter, right? Ken basically is the management company who will eventually run the asset. So you can see already there are three different sides. Of course, one is the business itself. For example, we have seen so many listings. Those listings are actually the owner themselves continuing to own, albeit the fact that they actually have a more diluted stake, what we call public spread, right? So whereas SPACs are very different, if you look at how Hibiscus, the team of management comes about, basically raise the core equity, and then we come out and raise the balance of the equity, which is what we consider the money that we raise from the IPO. But they continue, the management team are the sponsors and they run the company. But in the US, if you look at it, the people who are sponsoring are actually the fund managers, right? They're not really the owners of Grab. So they buy into Grab as potentially what we call a merger situation. That means they merge themselves with Grab and then eventually become a listco. So that is slightly different from the Malaysian scenario, where we actually so far all the 5 SPACs that we have in Malaysia are actually management promoted SPACs, in the sense that these people become, and they actually very specifically discuss about the actual investment that they're going into, right? In Malaysia, you notice that all our SPAC target acquisitions actually are very clearly defined in the prospectus, in the sense that exactly which area of the business that they are going in and all that. Whereas in the States, I mean, you can actually have a fund manager, for example, like, a promoter like Upin Huang or even Hong Leong Asset Management. We can be the promoter who actually raises back and say, okay, we will buy into companies that is in certain sector, let's say healthcare or in any other sectors that we want to do. So that's the slight difference between the SPAC model and the in Malaysia and in the US. Then, of course, we have made the distinctions between the traditional IPOs and the SPAC companies. Then, of course, then there's another whole set of rules that will come in, in terms of between what a SPAC can do and what a SPAC can't do. Very clear. I think most of us would know, I mean, without going into too much technical, that in SPACs, the three to five basic rules is that when you raise money from a SPAC, you have 3 years to complete a qualifying acquisition. And you actually need to put all your money, 90% of it, in the trust account, controlled by third-party trustee. And the management has about 5 to 10% to use in the 3 years, to spend while looking for the asset. So basically, what is critical is that that from an investor's perspective, the money is safe until we find an acquisition. And why the investors feel safe is that they actually ultimately has a say in whether the acquisition will go through, right? You need to have 75% shareholders approval when you seek a qualifying acquisition in terms of what the SPAC can actually buy. So that's where the investor protection comes about. But that I just wanted to highlight the basic difference in terms of the promoter space. That is actually the main difference between the US space and the Malaysian space. So far, we haven't seen a sponsor like someone being a fund manager to come out and sponsor a SPAC, and then after that acquire businesses via a merger kind of arrangement. Yeah.
Mm. Although that's something that may be in the works in the future, right? For us in Malaysia and Southeast Asia, essentially, I mean, potentially.
Yeah, I think the key is that, of course, I think is a question of whether the regulators actually look at it differently. Because at the end of the day, if you trust that a fund manager, for example, if I'm a private equity firm, right? If I'm, for example, I just take off the beat, I'm Nevis. I want to look and raise a SPAC. I mean, the fact is that I've been a private equity firm for so long. I should have the expertise to scout for investments, right? So you don't have to say, okay, because in Malaysia, predominantly they pre-qualify the team already. For example, if it is Ken, they will look at his relevant experience, they will look at exactly what he has done before, whether he has the actual expertise to succeed in the area that they come in. Whereas in the case of in US, you would have someone like Nevis coming in and say, okay, I want to buy into a company like Hibiscus or something like that, or a potential other business. So that is a slight difference between the two. But we wouldn't say that neither one is wrong. But I think in a way, it actually opens up a little bit more flexibility in the promotion, the sponsorship. Because at the end of the day, if I'm a private equity firm, if other investors, of course, the only difference is that private equity tend to raise a lot more from the sophisticated investors, right? Whereas in this SPAC, I mean, the investors are the man on the street. It can be anybody. So that is a slight difference. But then there's really, you have your safeguards there, in a sense that you still have a say, you still have a right to approve and disapprove an investment. So I don't think it's something that won't work in Malaysia as well. Actually, because that also gives a chance of the Malaysian public to actually participate in, I mean, a lot of private equity have done so well over the years, right? I mean, investing and to be able to actually put your money to a private equity fund that's listed, actually. That's the only way I see it as a fund manager promoted SPAC. Yeah.
Actually, Jim, Leng, you've said it so well, I must say, in that. And in that terms, and you talked about earlier about when the market is ready, bringing products at the right time. I think at this stage where you got a couple of things going forward on investments, right? Interest rates are so low. People are looking for different types. Going straight, I know I would like to go to a private equity firm, but you go and talk to Brahma like Credo, he'll say, well, I need X million bucks before I even look at your. I think you talked about a little lower for individuals. But the problem is, I think we just had a chat with them and they were saying, we're talking to people like, the private equity firms. The fund managers are so after their funds these days. There's no chance for, individuals to even look at, get a look in. So I think if you're talking about diversity and growing of the capital markets, that's one aspect. Second, with with the potential for inflation rising, I mean, here is another chance of diversifying my investments. And for products that if I like that management team, I should be able to back them.
Yeah. I think okay. I don't know why I'm seeing some messages here. Okay, the key is that at the end of the day, right? I mean, you look at where we are right now. I mean, at the end of the day, like you say, when interest rates are so low, I think the key is that we have been, investors so far have been participating in IPOs where, the traditional form of IPOs, but then they missed out really in the private equity markets. And the private equity markets are so far, I mean, if you really look at it, I mean, if the fund managers are good, actually is a fairly good proposition even for the private equity, I mean, the public at large to go in. I mean, today we talk about the lead markets. The lead markets in a way is also in a way the private equity sophisticated investor market, right? But then of course that one they actually limit by the ability of the pre-qualifying criteria for investors for lead markets. But really at the end of the day, I think the market can get more sophisticated, and then ultimately then the key is that you look at the kind of risk spectrum, what you would like to go in, and no difference from a lot of this people offering microfinancing, I mean the P2Ps, these are very much so-called the private equity kind of ventures. But then, of course, in terms of SPAC, I mean, what it provides is that it provides a lot more liquidity via the stock markets, right? In a sense that a lot of people look at it and say, okay, I don't mind putting in the risk, but then when I need money, how do I raise money and cash out, right? If you look at a typical private equity venture, it's not so easy to come through. I mean, because most of them would have raised money through the funding platform. You raise a fund and the fund will be locked up for 5 to 7 years, right? From the start to the disposal. But, most investors, I mean, who actually are willing to take the risk may not have that kind of investment horizon. Right, so the SPAC actually provide them via an IPO listing, actually allow them that kind of flexibility. Of course, everything is market driven. I mean, when you want to sell, whatever the market is giving you we would say it's a fair market lah. But I mean, nobody should be able to really arbitrage if it's liquid enough. That's why people like US in a sense that the SPAC size are big and it tends to have a lot more liquidity in that sense, right? So that when you sell, that's a fair market price. It's not a arbitrage price where people actually look at it, because markets that has less liquidity tend to suffer from that kind of liquidity discount, where when you want to sell, you actually don't get the true value of the investments, right? So that's the only difference. But we think that the market actually in Malaysia especially, it's matured enough to have instruments, because if you look at the whole space, right, I mean, we have the more safer investments like the REITs and all that, which I'm sure most of us would know, but some people are actually looking for more growth. No difference from today. We say, why people putting money in Bitcoins and things like that, right? People say, okay, it's out of my $10 of saving, my last $1, I don't mind putting in some risky asset because I still have 90% of it in very safe assets, right? So what is that $1? So that $1 could be going into cryptos, could be going to Bitcoins, could be going into SPACs. I mean, there's nothing wrong with it actually. It's just an asset allocation strategy, even for an individual, right?
Makes sense.
And on that note, I think when you say about markets changing, that's what we talked about a little bit. Is today, I mean, I know the regulators say, well, you don't crash on my watch, lah. That's where they will say. But reality is today, any of us can go onto the online platforms, buy US stocks, buy UK stocks. We can buy anything around the world. And even like you rightly pointed out, P2P, I was amazed when we had Vincent on here on Money Safe, and he's talking about 8-9% and 460 transactions, not a single bad loan according to him. So again, it just shows what is out there. But I think the more interesting point is this whole idea of capital formation. In this market, how would you see, or who should be thinking of SPACs? If I'm an entrepreneur, who should be thinking of SPACs in this period of time, perhaps?
Actually, at the end of the day, right, I mean, if you already meet the profit track record and, you can list on your own, you don't really need to go into SPACs, right? So far, if you look at Malaysia experience, of course, it's quite heavily tilted. I mean, four out of 5 SPACs are all oil and gas. And oil and gas is because really, if you look at people going into the oil fields and all that, they don't really have the record. I mean, they have the reserves, they have the engineering studies that shows that, certain potential in drilling, but they don't have the profit track record. But then it doesn't mean there are no expertise in that area, right? For example, if you look at people like the US big especially the tech sectors, today we are talking about digital. Everything is about digital. But then the question a lot of people ask is that if you go for the traditional IPO markets, will they get the kind of valuation that they want in terms of offering an IPO in the digital space? So, and some of them may not even have the profit track record, right? I mean, because, when you start with digital, it's the same as Hong Leong when we built our online. I mean, the money you spend building an online, once you reach that mass, everything else that come in is basically profits, right? I mean, because the infrastructure you spend building that platform is actually quite fixed. But then you need to build it first, right? But then initially you may not have that so-called profit track record to actually meet. But then you still need to invest in growth. You still need to bring in, just like Amazon took them years to actually start to be profitable. But then to companies like them, is it sunset that they can't raise any more capital? No, right? I mean, there will be people who are sophisticated enough who knows that when it comes to that critical mass, you actually will become profitable. So SPACs actually fits very well in that little space. That's why what we are calling SPACs is that actually, if you really ask me, I would define them as more a listed private equity approach, in a sense that where traditionally is unreachable to the public, now the public has a chance to invest, in a much smaller pie slicing that gives us a chance to look at some of this private equity space where really, if ultimately what will fail is that, of course, if you buy into a company that, in anything you invest, there's always risk, right? It doesn't mean that it will, but you look at today, I mean, not just SPACs. I mean, there has been some discussion that it's losing its flavor because some of the SPACs has not done well. But then there are also equally IPOs that hasn't done well. It's not just SPACs that hasn't done well. So I think we shouldn't label it together and say it's SPACs that hasn't done well. No, I
it's
think
more the industry, the management,
and we have to take it in perspective, I guess, right? Timing and so a whole bunch of other things. We got a whole bunch of folks that have joined us. Thank you guys. Abdul Shukur and Shamsuddin and I think Aini has a comment that says, hey, agree with Ravi, whether or not we notice investments is moving towards a borderless world from the investor perspective. So keep your comments coming. I think there's a question from David. We'll get that right after the break. We're going to take a short break, 30 seconds. And again, this time it's going to be a Hokkien break. And we're going to look at Necole.
She's from
Hokkien. Oh, so okay, great. Jim Ling may understand a bit of Hokkien here. So we'll take a quick short Necole break and we'll be right back here with Jim Ling, CEO of Hong Leong Investments.
Jackie 啊，
OK，
你有冇聽啲咧叫 app 叫 Necole 咯？
Necole 是什麼？
唔是啦，我教你講 app 啦嘛。嘅你看啲 Necole 你看，依家了後真正係 article、podcast、courses 嘅啊。我教你講啊，你愛變好名，你好名，
愛好名啊，第啲
你愛吞水無？
吞這類咯。
啊，所以啊，你特別用 Necole，做咩事？你睇啦，你看誒 article 嘅咧，你睇啦，你變真搞嘅知無？
唔嘢無，嚟我看啲。
有年你看啲 article 看按照好名，按照吞這類，哇！哎呀，你睇。
一個看好了嘛，進來就搞。
有啦，教你講了嘛，你咪聽，當見到特別去看，特別看個了，睇個了，
你講你這邊搞啦，我
OK， 好，我先好來。
Welcome back to Rethinking Balance Sheet. And for those of you who haven't got your personalized Necole, get it at Necole.app. It's very, very cheap, but it's a great AI personalized tool that you can use. We're talking to Jim Ling, CEO of Hong Leong Investment Bank. Very exciting conversation on SPACs and a whole bunch of other things. I think there's a couple of comments coming in from people, some questions coming in. I think one question from David Liu, who asked a little bit about, can you share a little on the rolling fund model as an alternative, pros and cons?
I think, well, at the end of the day, I don't know really what is a rolling fund model, but I think, I mean, from what I've seen, I mean, I don't know what maybe David would like to elaborate.
Explain a little bit, yeah. What's the question?
Is it a case where they're talking about having a program that keep raising funds, through the stage of the investments? I mean, from what we understand is that if you are a private equity, I mean, of course, you actually keep raising new funds, right? I mean, at the end of the day, you raise a fund today, and then, of course, what people do is that when the fund ends, you roll it into a new fund, and then that new fund will cross over as a new NAV. So I'm not sure whether David is referring to that, but that can happen. But then at the end of the day, of course, there's only one thing that drives the two difference, right? It's the valuation. So at the end of the day, when you come to the SPAC market, I presume what people is able to get will be a much better valuation as compared to a rolling fund. Because rolling fund, ultimately, I believe, because I work on a private equity fund before, most funds would have something like a 5 to 7 year kind of maturity, right? When it comes to the 5-7 years, you need to exit. Now then, when you can't exit, you probably roll it into a new fund where you cross over to a new fund on a new group of investors. But then at the end of the day, this new group are likely going to be again sophisticated investors. So the valuation that they ascribe to bring in the the roll over into the new fund may not be as high as what potentially they can get. So, for example, it's the same principle. I mean, today I don't think a fund like, an investment like Grab wouldn't be able to get investors, right? But after a while, you come to a phase where you really want to crystallize up a bit. You will want a much better valuation. So ultimately, to me, I think it boils down to also just a valuation. Of course,
Yeah.
rolling over.
Yep.
Much simpler, you just need to get the investors to agree on the terms, and then you can get through. You don't have to do so much as compared to a listing, to go through the whole a framework, of clearing raise and writing up all the whole prospectus statement. But I think ultimately, to me, it boils down to valuation.
Right.
Right.
And,
Just like today,
that-
you can raise private equity, you can go for a listing. Why, if private equity offers the same valuation, and why would someone go private equity and not go for not private equity and just go for listing? So it's very clear. I mean, you look at it. In fact, most of the listings are coming through private equity exiting the business, right? So you can see already it's a staged process where you actually come here, go private equity, then only go listing. So so it's quite clear. I mean, you look at some of the listings of late, most of them actually has private equity as part of the promoters. I mean, we look at the recent listing, even Leong Hub, even DIY promoters are actually private equity, like Ravi knows, right? Credor is a big promoter, and basically that's when the private equity actually comes out to actually catch up. So you look at that kind of valuation platform, you can definitely see there is a difference. Yeah.
Okay. And
I don't know whether that answers David's question.
Yeah, I think he's talked. Yeah, and we can get back to that in a little bit. I think there's a very interesting question from Daniel, and Daniel says, can SPACs be formed for the purpose of multiple company acquisitions? Meaning to say, is there a route for an individual with a good track record for investments to create a SPAC for the purpose of acquiring multiple synergistic companies and then listing the group at a holding company premium?
Okay. If you really ask me, there's nothing that's impossible. But then there are two things that will be very clear, right? First of all, what do you tell the investors, and whether the Securities Commission, the regulators, really do think that the management has that expertise to buy the various business, right? So like I say, in the US, actually, it's very clear. If I'm a fund manager, I've invested in so many industries, you should give me that benefit of doubt and confidence that I'm able to actually look at investment in various sectors. But so far, in the Malaysian experience, we haven't had that yet. Most of them are actually very industry specific. For example, I mean, the 4 oil and gas is very clear when they write it into their investment statement that, they are definitely only going into very specific areas, in fact, very specific areas of oil and gas. So, for example, like the only different one that is in Malaysia is the Red Sena case, right? And that one is the only one that says, okay, they target F&Bs. But even within F&B, it's so wide, they need to very clearly specify which part of the F&B, because if it is a management team listing, then of course the regulators are very clear. You must have skin in the game. You must know the industry well enough, right? So that's why they look at the experience of the management team. So, for example, like if Lee Ling go and start a SPAC, then of course my argument is that I'm an investment banker. I've looked at industry in so much field. I've invested in so many things. So maybe I can still try and go to the regulators and say, okay, can you allow me into multiple industries that I can invest in, because I've actually have expertise, and I may not be the person running it. The person in the business that I'm acquired will run it, because via a merger scheme, they will get shares anyway, right? So there is already the mutual sponsorship of interest. So that may be a model that can evolve actually in Malaysia. But so far in Malaysia, we haven't had that yet. The last 5 SPACs are all very much driven by management as the sponsor, and because management has a sponsor, their experience may only be related to the industry that they've been operating. For example, in the case of Red Sena, more or less they are very familiar only the F&B industry, so that's why they have to put in their investment statement in the prospectus that they're actually doing very specific acquisition in that particular. But of course, that to us raises a little bit of the difficulties that people can arbitrage. They know that you have 3-year horizon, you need to buy something, and you only can buy something in that segment. So the sellers tend to sometimes make it very difficult. That's why we look at it. These are some of the impediments in the SPACs, in the sense that if it is so specific, and the utilization has to be so specific, so they know that, okay, if my asset fits your criteria, then very difficult for you to go anywhere. Then there could be room for people to arbitrage on the valuations itself. So whereas I think the US model offer a little bit more flexibility, that if I'm a fund manager, I put like I said, there's nothing to stop a fund manager from saying, I want to look at investments in the tech sector, even within the digital space, there's so many areas, right? So if the investor like it, then we say, what is the issue, right? The key about SPAC is that you must trust the management team. I mean, whoever that is actually helping you with the acquisition, looking after your interests. If you believe them, you put your money with them. No difference from in any of the investments we make, right? So we are not saying that it can't be done, but currently that framework hasn't been in place in Malaysia yet to allow a SPAC to actually go into multiple businesses. So far, it's management driven. Unless that manager itself has got so much experience. So the only manager that can have that kind of experience, I believe, is actually the fund managers. They have invested. For example, someone like Bramal or Nick Bloy, who has actually done so much investment in different sector. To come in and do a promotion of a SPAC, yes.
What about? I mean, there might be areas where managers, running a space, say they are in an industry or a space, and they may have, ideas on how to integrate, that space and consolidate maybe. And would that be a possibility also?
Yeah, it can. I say ultimately is what you actually demonstrate to the regulators. Because listing of a SPAC, what are they, right? When you list, you only raise cash. Now then, the only comfort you can give to the regulators is that you have that expertise to make that decision, right?
Yeah. So as long as you can demonstrate that, yeah.
Yes, you need to demonstrate that. So it's what we call actually SPACs are listing of management capabilities, right, or sponsor capabilities. So in that sense, if you want to demonstrate to the regulators that you are capable of running an investment, of looking at an evaluation of investment in that space, I don't think it's something that can actually stop it. But then that is the key part, really convincing not just the regulators, the investors themselves, because ultimately they'll be looking at the public document whether they put their trust in you, right? Because any SPAC that receive approval from the regulators and don't get money from the man on the street or investors is still a failure,
Sorry, go on, Roshan.
No, go ahead, Ravi, because I got a whole bunch of questions from people, so I want to
very quickly on this question about, you talked again, coming back to your very good point about the market evolution. We know post-pandemic there's so many things that are going to change. I will not have a track record, right? We also know clean energy is going to be, maybe pharmaceuticals a bit difficult but we also know in the way retail is going to be done. But I can't demonstrate a track record. Will SPACs work, or have you got to go back the traditional way, go get some angel investor, or is there a role for someone like an aggregator like you to come in and say, look, there's a lot of these kind of industries out there, get a fund manager and say, let's go and start. I think that's where Roshan was alluding to as well. If I'm going to look at clean energy, maybe not all of them are great track records yet, but SPACs may be the way forward. We had oil and gas previously, but now let's think about clean energy.
And I think we talked about this briefly, Ravi, in one of the earlier episodes about consolidation. It's a good time to consolidate, especially with many companies suffering. But some sort of industry consolidation in some of these industries may make sense. I got a whole bunch of questions. One from Delvin, who basically says, look, there's a lot of SPAC failures in Malaysia. Red Sena, Sona Petroleum, to name a couple. Why did this happen? And tell us a bit about some of your thoughts on this. Ling.
I think so far, as I briefly mentioned earlier, why there were, if you look at all the 5 SPACs we had, right, I can even name it in my mind, because we did the first Hibiscus, and then we also came through with Click, and then we had another one, Sona Petroleum, and then we had Reach, and then finally Red Sena, right? So these are the 5 actually. But if you look at the various levels, right, it's very different in the sense that, but most of it failed at the QA. Either 2 things, they cannot find a QA, or at the QA, they are unable to get the shareholder support. Now, why is that the case? Because there are 2 things now. I think most of people would have realized after going through. I mean, in Malaysia, most of us as a player would have realized after going through the 5, right? Because when we did Hibiscus, I think everything was so smooth because it was the first one, and we had a lot of hype, and then there was no issues with the QA. Because I think what was also fundamental was when we actually went out for the QA, the price of the shares has actually ramped up so much that it was much above the cash liquidation value, right? So people people don't see a reason to actually go for the cash when you can sell at the market for much higher value than the cash, right? But in some of the other ones, we were not so fortunate, because when the shares were listed, somehow a lot of the shares were actually trading below cash value, right? Now, when it's below cash value, of course, the investors become a little bit more stringent. I mean, if I can get back cash, let's say 90 cents from the company, why should I take the risk now? Because if I sell the share was only trading at 70. So some of the fundamental issue was that there was a gap between the cash value and the market price of the shares. Now, in my dissection of what has happened in the history, I mean, I feel that some of this could be contributed with the fact that, you know, most of these SPACs came with the issuance of the warrants, right? Because the warrants have actually been detached from the mother shares itself at the IPO. Some people would have actually got back some money from selling the warrants or trading the warrants, that, you know, the cash value then become lower. But technically it shouldn't, because in a theoretical sense, the mother should never trade below the cash, because why should you worry about having a discount to cash, right? It just doesn't make sense. But somehow in the Malaysian scenario, unfortunately, despite even Hong Leong, I mean, as a promoter, we are very passionate about it. We've been writing research reports, advising clients, telling investors that they shouldn't sell below cash value because there's no reason to. But yet somehow some decided to actually cash out, take the mother share back, and then hold the warrants, which they see as maybe a cheaper form of holding the equity piece, right? Because, you know, warrants are very clearly, people know, it's a leverage instrument where, you know, for 10 cents, it could give you an exposure into a $1 share, right? So in that sense, people feel that maybe instead of holding the mother shares at 60 cents, I hold the warrant at 20 cents, it's much cheaper to hold. So, but that is why, you know, the shares have actually been performing below cash value, which I think is a very abnormal situation in Malaysia. But unfortunately, that has been the key hindrance in actually the failure of SPACs, because when you have that incident happening at the EGM itself, when you want to go for a QA, right, the investors will always get very concerned. I mean, those investors who really want to block the acquisition, they wouldn't have blocked it if they could have cashed out at a much higher value than the cash. But because they couldn't cash out, then they will come to the EGM and vote against it to take back their cash, right? So that has been, to me, fundamentally the biggest issue that has affected some of the failures in the SPACs that we are seeing in Malaysia. Yeah.
Yeah. Okay. Thanks so much. You know, David sort of came back with a whole bunch of comments on that you know, earlier on, and he says, you know, from his research, he thinks that rolling fund is a hot new type of investment that allows managers to invest at their discretion in opportunities on behalf of the investors. And he adds on, you know, he says, I think rolling versus SPAC is hot because they continually raise funding. B, they provide investors flexibility, not locked up, and they provide more sort of fewer legal headaches. You know, he adds a couple more comments. I'm just going to run through a couple of David's comments, and then maybe you can just say, you know, he gives an example: 100 angels each write 5K checks. This becomes 500K syndicated investment into a target company, and syndication such lowers the bar to angel investing and provides a greater level of access to startup deal flowing. However, rolling funds have destroyed this bar almost completely, he thinks. So again, you know, I'm not sure if this is, I think it's just his thoughts and his comments, but you know, if you have a quick comment on that, and on top of that, Paul sort of asked you a question, you know, what's your advice, Jim Ling, on listing in the Bursa, SGX, or New York Stock Exchange as a preferred jurisdiction, sorry.
Okay, I think really, if you ask me, I mean, it's not a question of preferred. I think at the end of the day, we have seen also companies like, for example, if one simple question people ask you, why do you see a whole list of China companies all coming to list in Malaysia, right? So then the question we ask is that, why are they coming here? That's the same question I always ask people when they come to list in Malaysia. I say, why choose Malaysia, right? Same thing as in, so there's really no clear-cut answer as to whether it's Malaysia, Singapore, or New York. But then I think at the end of the day, some of the sizes of the company does affect. Like, some people find that, you know, a lot of people also say they want to list in Hong Kong because the premiums are good, you know, the valuations are good. But then at the end of the day, if you're not big enough, you're not big for the market, because people look at the size of the companies, right? So if you look at a lot of the companies, if your market caps are so small, it doesn't make sense for you to even reach the New York markets, right? So, and similarly, SGX is also trying to promote, I think, in a way, listing really offering a lot more debt, because in Singapore, I think the retail investors are very sophisticated. There's a huge retail high net worth following. But again, Singapore, you look at the market cap, if it's something like 300 million in Malaysia, roughly is about 100 million in Singapore. It may not be big enough for investor appetite. And why do you talk about investor appetite? Ultimately, like I said, it's only the valuation. Which market? If I'm a guy looking to list a company, right? Everywhere is the same. I mean, I'm looking whether I'm selling equity or I'm raising equity. I hope to get the best valuation. There's no two contrasting parts about it, right? So which market I choose is really which market gives me the best valuation when I want to raise money. So to answer that question, there's no clear cut. But in Malaysia, I mean, we have seen some very good listings. I mean, you look at recently the success of DIY. I mean, it's a clear benchmark, right? I mean, people initially say, oh, high PE, high PEs. But then, at the end of the day, there's no really market-driven, say, a one unit, a single PE that applies to everybody. But DIY is a very happy success story for Malaysia that, managed to raise money and continuing to do well. I mean, in a sense, so PE is all about fund managers, whether they actually believe that the company deserves that kind of valuation. So I mean, there's no clear-cut answer to speak of.
No, that makes a lot of sense. Daniel kind of follows through with the thanks for the exploring the idea of the multiple company exclusion through the SPACs. Based on your insights shared, it sounds like SPACs in Malaysia mirror that of an MBO rather than a blank check investment vehicle. Your quick thoughts on that?
Yeah. I think he's not wrong, because in a way, it looks like that. But then at the end of the day, of course, the only difference is that the management team may not be the same business that they're in. Whereas in MBOs, you tend to buy back the business that you're working on. Whereas in the SPAC, you're not supposed to have a pre-identified investment. You are supposed to buy a third-party investment. So in that sense, you are not supposedly having an investment already, something that you have already invested in. No. I think that's the only difference, in the sense that you're not supposed to be able to even identify what you want to buy yet. So in the case where, if you really have something and you say, okay, I go and raise money and then buy over my business, or I actually go to a bank and raise money to actually take over, that's a very different proposition. So that's the only difference. But yes, in a way, listing of the management capabilities is right. Yeah.
Okay, so we got a couple more questions. I'm going to try to take as many as well, but we want to get to some of our questions also. So David kind of asked, do we have an ASEAN level organization or group that meets and shares best practices for these emerging capital and financial instruments? Perhaps you and maybe Hong Leong Investments are part of this, or is there one, Jim Ling?
I don't think we have an ASEAN level yet. I mean, so far, of course, in Malaysia, we have our MIBA, that actually has constant dialogues with our regulators. And then, of course, through MIBA, we do actually have interfacing with the ASEAN side, right? In the sense that we talk about the stock exchanges, looking at all the various collaboration. We do have that level via MIBA, but not a direct level of
maybe it's time Ravi sort of builds something like this, Ravi?
But
maybe this show is the starting point.
No, I think that's it's just been so many great questions this morning. But just without sounding too defensive of the regulator, given that I was ex-Bursa anyway myself. But one of the things I think to the audience out there, you got to appreciate, the products get better as we go. So, you unless you launch the SPAC, you're never going to learn it. The stuff that, Ms. Lee was talking about, this happened, that happened. You've got to start somewhere. You can't be afraid of failure. But I think what you need to do is you're going to adapt. And that's, I really hope the regulators are hearing us out, and some great ideas coming out today. And we continue to adapt as the only way forward, rather than just saying, oh, this is a failure, this went wrong. No, there's no failures. There's only trying.
Yeah. I think it's not it's not so much a failure, in the sense that I think what we need to do is learn from it. That's why I think some of the feedbacks we've also been giving it to regulators as to why we think some of it didn't make it past the QA. So the key is that really, I mean, of course, like earlier on the discussion about the rolling fund. Yes, I think that one, I mean, in a way is interesting, but like I said, the only reason there is a room for for some of these SPACs is that really, I mean, from their perspective, I mean, you know, if the rolling fund is so available, why would someone like in Grab's case, you know, would still want to go for the SPAC market, right? So I think the key is really, from our perspective, maybe, you know, they actually can raise capital at very good valuations. And obviously from that perspective, and somehow or rather, we were also amazed at the evolution that the amount of money we can raise from SPAC has actually grown. I mean, if you look at the first one, Hibiscus, 150 million, to the last one we did at Reach was 750 million. I mean, it could potentially even reach $1 billion, because when we did Reach, I recall it was 8 times oversubscribed. Right.
Wow.
So you look at the so in that sense, you know, you look at the value, the volume of money is actually not there. You know, there's plenty of liquidity. Investors are consistently looking at investments. It's kind of what type of investments that they can buy, right? So if you say a SPAC can only raise 150, the short answer is not really true. You know, in fact, we had so many billions of acquisition. We only wanted to raise 750 in Reach at that point in time, right? So that is the kind of numbers we're talking about today. That's why there's no clear way to say which is better or the other. But I mean, there must be certain propositions as to why people come to that particular space to do it. And then, of course, it depends on the timing to market as well, right? I mean, like we say, sometimes when
true.
the timing is right, just like now today, we are seeing a lot more interest in IPOs. Why? Because people have seen success in getting good valuations. So it's always a window of opportunity. There's no clear cut as to which one is the best. But the private equity funds are also very successful in the sense that because they're not really so dependent on market. I mean, people are really looking at investments all the time and literally from that perspective. And today, of course, there's been a lot more with the introduction of private equity offering it to the mass market, right? There's also a lot more opportunity for people to look at that space as well, because today it is very different from last time. I mean, they're also putting down private equity into more bite size. So there's a lot more people who can actually invest the public at large to go into private equities as well. Yeah.
So Jim Ling, you know, I think some fantastic thoughts, and I think you've been talking nonstop. But I want to end with maybe something a little bit more practical for some of our other viewers. You know, and you know, there's a lot of you know, we had Dato Nora last week from Maybank on our show, and she was talking about getting young women into the finance space. I mean, what sort of advice would you give to younger women, especially pursuing a career in finance, and you know, advice to women in general in finance?
Actually, you know, there's only one advice. I mean, you know, first of all, you know, if we are in the finance industry, I think the key thing is, I always tell people, you always start with passion, right? You must like this industry. I mean, if you don't like, today I see a lot of people who actually don't stay long in the industry because they feel that, you know, they after a while they find that they may not like the sector. Like I say, you know, I actually find this sector is not for the faint heart. I mean, it's a very, very tough industry. You know, constantly having evolution, having challenges in the market, especially investment banking. I mean, we start with zero based every year. You know, I mean, at the end of the day, you are like a property developer hunting for sales every year, right? So it's actually not for the faint heart. But then I think is very rewarding if you actually enjoy what you do. You need to have that passion. But then I don't think there's any difference between the finance industry and non-finance. Of course, if we talk about whether women being in a job, that's of course very different. I mean, a lot of us say, you know, we have all this discussion and we won't go deep into it about all the glass ceilings, why women feel guilty spending so much time at work and not at home taking care of the kids and the parents. But I think we have gone beyond that. Today, you look at diversity, you know, in women. But the little bit of advice, like I said, it has to start with passion. And I think the finance industry, I personally have found it very rewarding because we actually get to see a whole lot more of sectors, rather than, okay, if you work in one particular company, you can start and build a very successful career, yes, but then the difference is here, you know, I mean, over the last 20-30 years, you know, we have seen so many aspects of the different sectors of the economy. Like we have done deals in plantations, we have done deals in property, we've done deals in healthcare, we have done deals in oil and gas, right? So there's no particular sector that we would like to say be in, but then it becomes what is available in the market, right? The thematic deals that is available. So it is very rewarding in a sense that you actually get to learn from a lot
Yep.
more prospects. I mean, in terms of your exposure
and the
to
diversity of experience. And the diversity of experiences. Yeah. So, a lot of comments coming in. David says, thank you for being amazing as always. Aini is talking about passion. That's the magic word. And another thank you for sharing your insights. So, keep your comments coming. I'm going to just ask Ravi to close us out with his final thoughts. And then, Jim, I'll get back to you with your final piece of advice that you want to leave our viewers with. But let's talk to Ravi and give him his time to give us his final thoughts.
I'm afraid I'm speechless. I think what Jim Ling's been speaking so long. There's just so many great things there that she came out. But without being a little bit pedantic, but I will say this lah. When I heard you said what you talked about Ken and working with that blew me away. Yeah, and willing to take that chance. And so David Leo was out there and thinking about this rolling fund. Maybe Jim Ling is the investment banker for you to have that.
I'm thinking of getting her. I'm thinking of leveraging her. The don't pay anything offer. Anyway,
but I just think a great show, Jim Ling. Thank you so much.
And
thank you
Jim,
for
just
having me as well.
Sure. And just kind of to wrap it up, any final thoughts or any final piece of advice that you want to leave with us as we close out the show?
Yeah, I think today, since we are talking about SPACs, I think really, I think what I would like to share is that I think never feel that there's a single product. But I think in every case, I think a good investment bank advisor would actually point you to the right thing. It's not just about raising money; it's the best structure of money that you should raise. I mean, for example, like today, it's not a topic today, but we have also evolved to look at perpetuals and all that, different classes of equity. So there's no one product that fits everyone. But I think what I like to part with all of you is that, a good investment banker, which I hope to say I am one, would really look very closely at what you need and not just what you want to sell. That's very clear, because that is what I tell my staff every day. Don't look at the profits that you can make from a deal first. Look at what the client needs. I think at the end of the day, it's very important that we have to go beyond that kind of framework. Don't look from day one when you look at the transaction and say, oh, how much money can we make from that transaction, and then try to sell that to the client. Actually, it should go the other way around. Find out what they really need. That should be the really true blue what an investment advisor should be. Yeah. So we talk
Fantastic.
About people selling. Yeah, of course, if I'm a guy trying to sell something, if I have a suitcase of products, I'll sell you my best margin products first, right? But then ultimately, the guy may not need it, right? So
absolutely.
we should actually start from the other round. That's what we call responsible bankers. That's where the evolution should be. Look at the client's interest as a start. Yeah.
Yep. There you go. Responsible banking, right?
Just on that note, maybe it's not the 7% on selling $1 billion of bonds, lah. Sell down the bonds. We won't mention investment bankers which work on the basis of let's sell the bonds with a government guarantee, buy it cheap and sell down at 7%. And walk away with $1 billion US. Yeah, we won't mention names, lah.
So lots of comments coming in. Thank you for a very interesting Friday morning for a lot of you. Jim Ling, it's been absolute amazing to have you on our show. Look forward to having you again and having a deeper probably dialogue on some of the offerings of Hong Leong Investment Bank and other things. So we're gonna, as always, we're gonna wrap it up. It's about an hour now. We're gonna wrap it up, and we want to thank you and wish you a fantastic weekend, everyone. Have a great weekend. Remember, keep staying safe. It's still dangerous out there, and stay at home and enjoy yourself. And remember, SPACs are an option for some of you. We're going to end with a short little video on Happily, and we will see you next week, same time, 10 a.m. GMT +7 KL, Beijing, and Singapore time here on Rethinking Balance Sheet. Signing off for now. This is Roshan and Ravi. Goodbye, everyone. Have a great weekend.
Bye. Stay safe.